So welcome to tonight's Master the Trade webinar. For those of you that are new, please let me draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone does not represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So again, welcome. So the Thanksgiving holiday is behind us and markets are fast closing in on Christmas, but that doesn't mean that the markets are actually slowing down. Stocks continue to hang around the highs, the dollar remains on the back foot, and Brexit headlines continue to keep sterling on a yo-yo up and down. So for tonight's structure of the webinar, as you see on screen, for the professional trading education, Maurice is going to focus on explaining why forward-looking economic data is so important for the professional trader. And he's discussed in previous webinars the different types of the recoveries, whether it be a U, a V, or a K, for instance. But he's going to start to run through now why he considers this forward-looking data so important to identify which country or region is going to come out of the pandemic the strongest. He's going to then pass on to Richard Adcock, who's going to explain the structure he uses as an expert technical analysis expert to approach the week or day ahead. Roger Hawes will finish the professional trading education, building on last week's trading strategy, but this week he's going to talk about how to play the long game, developing your trading beyond the short-term horizon. After Roger finishes, we'll take questions before we move on to the real-time education, where first Maurice and then Richard will give their up-to-date assessment of where the markets are right now, and then also looking forward. So with that, I'll pass over to Maurice. Maurice, over to you.
Hey Chris, thanks and welcome. Good evening everybody. Glad to have you back. Anybody new, hopefully you'll enjoy this and come with us on this journey as we go through gradually educating ourselves to what we should be doing. The focus I want to concentrate on today is the economic data, but the side of it that I think is actually slightly more important. So we have two kinds of data. We have basically hard data that we call, which is sort of like GDP, retail sales, stuff we know is real. And then we have what's sort of called survey data, if you like, which is more forward looking. So what we have right now, we have hot headlines here. We know that these headlines are going to be hot. We've got the Brexit deal headlines, further vaccine news is always moving markets. We had the RBA rate decision we're waiting for this week, which came out. Fed chairman was speaking, and we're seeing a bit of a chink in the belief of market that post-pandemic stimulus is all that matters for stocks. Well, I'm not sure it is. I think we need to start looking at the data, and we need to start looking at what kind of recovery we're going to have in certain areas, which one's going to be the first out, which is going to be the strongest recovery, where the capital could flow, and what central banks are going to do with this. So I think, after the sort of knee-jerk reaction to unlocking and all the rest of it, the data is beginning to settle down a little bit, and we're now getting more reality in that. And there are some key components here that are starting to suggest that the recovery may not be as strong in some places as others. So, we've got the hot headlines that we know about, but also now we have key data that we've really got to concentrate on. Now, unemployment is a key hard data component, but the good thing about unemployment is that we get some quite high frequency updates on that. So it's extremely important, because also unemployment is something that a vaccine may not also be able to cure, by the way. GDP is rather more backward looking, and I do find that is sort of less informative for me, because you usually get it a quarter late maybe, or 2 or 3 weeks late. Remember, the markets are forward looking, and I think that makes a difference. So whilst these are sort of warm market focus at the moment, I think these data, this retail sales particularly, this PMI, IFO, ZEW sort of and ISM kind of data is going to turn hot now. So I think we need to have the data calendars on our screens, and we need to ask ourselves why this forward data is so important. The point is, you know, if we take the data that's sort of behind us, if you like, if you do your economics exams, you'll hear economists and the lecturers prattling on about GDP. Well, GDP is all very well, but markets look forward. So I would like to see data that shows me what's coming, not what's gone behind. Now, within this group on the right in green that is looking forward, the reason why it's looking forward is that PMI, ISM, IFOs, all these different words are basically surveys. Now, these surveys are interesting. Now, a lot of people say, well, why would a survey? It's only someone's opinion. But when you survey 700 businesses in your economy and you ask them questions about how are things going with new orders, what are your inventories looking like, what are you thinking about employment, are you hiring, are you firing? These give you a very good insight into what's happening at the coalface in businesses. Now, I think that is extraordinarily valuable information. And I think that now we're settling down on this data. This data is beginning to show some interesting points. We've seen PMIs on the services side of things. They're split into two. You have services, which is everything the consumer needs, really, hotels, restaurants, all the rest of it. And many of the major economies are survey-based, service-based economies. On the other side of that, we have manufacturing. Now, you know, the poster child at the moment has been manufacturing, but services are really lagging, particularly in Europe, which is a concern anywhere we have a consumer that drives the economy. So Europe, the UK, US are consumer-based economies, 70% plus in some cases. So this structure that we can get, this information we can get from business leaders, foreseeing what they see in coming months is vital. Initial data was awful due to the global shutdown. You can read through this list here. We expected to see improvements. We got massive spikes higher. It was too volatile, the data, to even take notice of, and the market actually ignored a lot of it. But then we're just getting to this period now where the settling down is beginning to allow us to take the data and project forward what we might be seeing coming around the corner. So I think we really need to concentrate on this. We saw this improvement start to happen in the PMI data in China, and they were the first ones to put the virus behind them. We've seen other emerging markets, particularly Asian markets, start to turn around quite well as well. And in fact, from that, we have seen international capital flow to those regions. Capital is flowing east. I think that is partly why we're seeing a weaker dollar as well. I think a lot of people see overvaluations in the US market. And the better valuations seem to be in Europe, the UK, and particularly in Asia. And a lot of money is going that way at the moment, hence the weaker dollar, stronger euro, stronger emerging market currencies, particularly in Asia. So, you know, we're highlighting the potential for financial markets, and we're looking for the winners and losers in this. And some of these PMI data give us an understanding of whether we're going to see a V recovery, a W recovery. Let's hope not an L, but we are seeing typical signs of a K-shaped recovery, which is, as I mentioned last week, you know, part of the economy doing extremely well, whilst the other part of the economy is actually suffering quite hard. We're beginning to see that change slightly as some of the reflation or recovery stocks and businesses do a lot better because the vaccine is on the way. So you remember though that the preliminary readings, we get 2 readings a month. We get a preliminary or flash reading, if you like, and then we get a final reading, which is the final look, which is usually pretty close to the original, but there's sometimes some fine tuning there. But the preliminary or flash readings there are the important ones to follow. And I think they do give us now a very good sign of what we can expect. And I think they're important. So I just thought I'd throw up a screen here that shows you some of the ways that we can deal with the data. Now, there's 3 things you've got to consider here. Obviously, apart from when the data comes out, you need to know when the data comes out. But then we have 3 things that we always look at. So the first thing I look at is what's expected. So I'll look at see what's expected, and then I also look to see what we had previously. So basically, I can see that China's manufacturing PMI was expected to be quite a lot lower from previous, but it actually came out slightly higher than the previous. So it looked like a massive beat of expectations, which was positive, but in fact, it was just slightly bigger than the previous period. But the market does react to basically, I think, what more so of what the consensus was rather than the previous was. So although it was seen as a very good number because it beat the expectations, and I think this is very important to look at as we go down this list here. We saw Japanese manufacturing PMIs beat both sides. We saw France actually beating. We saw Germany holding highs. You know, remember, anything above 50 is expansion, anything below is contraction. So Germany's still showing some pretty strong manufacturing structure there. EU was okay, it was more or less in line. UK was pretty strong, to be honest, given all we've looked at. The disappointment there was the one right at the bottom, which was the US ISM manufacturing. This is the Institute of Supply Management. That came in rather weak. And I think the other point of that was the employment component within that was also weak, which doesn't bode too well going into Friday's non-farm payrolls, which we'll talk about later. So plan and prepare, react. And if we look at the November takeaways, China still seems to be leading the pack, and Asia particularly leading us out of this structure. And where that happens, you will see the capital flow to. As I say, UK and EU services in contraction, but manufacturing holding up pretty well. So the service is not looking great in some places. If we see a turn back up in those, it will suggest to me that the consumer is in better shape, sort of starting able to spend again. We obviously need all the economies to open fully to get that, and we're not quite there yet. So there could be some delays until we see the services sectors rise from here, but we're getting some encouraging data now. Moving back into the 50s is expansion. And so we could have a recovery into the beginning of next year, which you're beginning to see priced in equities and actually in some bond markets, where we're actually seeing some early signs of green shoots of possible even inflation coming through. Some worries that pent up consumer spending may be upon us at some point next year when we have the vaccine in us. So that just gives you an idea of what we need to look at and the importance of forward-looking data. I wouldn't ignore hard data. I wouldn't ignore retail sales. I wouldn't ignore unemployment. But I just think there's real value in understanding what some of these survey datas are and what they mean for someone who's trying to take a view and keep up with forward-looking markets. Also, I think what you need going ahead is some expert technical advice, and I'm going to pass you on to my main man, Richard Adcock, to give you a heads up on that.
Great, thanks very much, Mo. Good evening, everybody. Hope you've had a good week so far. Over the previous weeks within these webinars, I've discussed various areas of technical analysis that I think are important, namely sort of momentum, trending, and sentiment, and looked at various indicators within those headings to gauge just where directional risks are developing. Now, what I wanted to do this week was to take it sort of one stage further and basically sort of highlight how I, as a so-called expert technical analyst, approach markets on a daily and weekly perspective, and just sort of give you an idea of the types of things I'm looking for, the types of structures I go through on a regular basis to try and establish where the most significant and most interesting trading opportunities are offered. Now, at this point, I should stress that this isn't me telling you how you should do it. We're very much sort of geared towards trying to allow you to sample some of the most interesting aspects, and for you to establish your own particular trading techniques and approaches that you find useful, that you trust, and that you most benefit from. So this is just to give you an insight into how I look at markets and how I would approach each trading day. So basically, before I sort of start trading and start to look at the analysis that I'm producing, I always try and ask myself the same questions, and that's basically which markets are trending, which crosses within FX, and which markets are seeing increasing volatility, be it to the up or to the downside, what's momentum telling me? Is it actually suggesting that we should be trading now as we speak, or is it telling me that we should hold off a little bit and wait for a new signal to actually trigger a new trading opportunity? But then also, more significantly, what are the significant levels that I need to monitor, not only in the markets that are actually flagging up potential trade ideas, but also within the markets that are actually sort of less interesting at the moment, but which points, if broken, would make things much more interesting for me and actually trigger an interest to actually initiate a trade. So what I've done is to just pick out 4 dollar crosses. These slides were made on Monday, so they're not quite up to date, but just to give you a sort of an idea of how I was approaching the beginning of the week. Now, the beauty of technical analysis is that once you get a template set up within your charting system, you can actually scroll through a large number of markets and get a decent feel for how the positions are actually developing and how the trading opportunities are actually materializing on a pretty consistent basis. So you can cover a lot of markets in a relatively short period of time. So I'm just going to look at 4 as I approach sort of the week that we're currently in. And the first question is, what's trending? Where are the more aggressive trending conditions and what's actually highlighting that should continue that trending perspective? So the first go-to indicator that I have for trending is the MACD. We've looked at the types of signals that are generated from the indicator. And basically what I'm interested in are the actual crosses that are seeing more aggressive trending conditions. So in other words, the MACD either above or below 0 and above or below its own moving average. So within these 4, the one that's still really sort of highlighted as a more aggressive trend was Kiwi versus US dollar. We're seeing a consistent move higher. The MACDs continue to move above 0 and above its moving average. So this is one that still suggests to me that we're seeing a more aggressive trending condition. Elsewhere, when we look at euro dollar, we can see that we're seeing a slightly more constructive trending condition. We've broken above the recent highs on the MACD as the market and cross has broken those levels. So effectively, we're starting to see more positive trending conditions coming into play. Similar with Aussie US, although you can see that the MACD is starting to perhaps roll over, so perhaps not aggressive, so not significant signals from a trending perspective. While finally for dollar Swiss, we can see that the MACD is moving around its 0 line. Prices are still caught in a sideways trading range with no aggressive trending condition in place. So effectively, it's really dollar Swiss that throws up that it's not necessarily trending in an aggressive way. So volatility, that's the next important thing. Where are the markets seeing increasing volatility within these positive trends? Well, again, it's Kiwi US dollar, where the market's trading within the upper band, the mid average is rising, the bands themselves are widening or are quite wide. So again, Kiwi dollar threw itself up as being a positive trending condition with increasing volatility. Euro dollar was more constructive, but we're still within this sort of choppy sideways trading range and the bands aren't necessarily widening aggressively. Same with dollar Swiss. Aussie dollar, you can see that even though we were seeing the MACD moving higher, it was beginning to roll over and volatility is starting to come out of the market. The bands are beginning to contract. So in other words, this is one area that perhaps we're not looking at an aggressive trending condition, and we're not starting to see the type of volatility that we would want to see to really give me confidence that the current trend is going to continue. So then we move on. So we've actually sort of narrowed it down to euro dollar and in particular Kiwi US dollar as being the more aggressive trending, seeing in volatility beginning to increase. So again, it's a matter of what's momentum saying. Well, having seen the crosses and the market rally so aggressively as the dollar weakness has continued to materialize, not surprisingly, momentum is still more constructive. You can see that actually euro dollar is actually seeing momentum historically high levels and moving ahead quite nicely, while the New Zealand US dollar is still moving higher. It's overextended, but we know in a trending condition that that's not a negative signal. So effectively, we're still looking at these two as highlighting potential ongoing trending conditions. So then it comes down to, okay, so what are the important levels that I need to be monitoring over the trading session to really highlight when we're likely to see an acceleration or continuation of the ongoing trends? So we know that Kiwi US dollar is trending in a more aggressive way. We're starting to see improving volatility. But the level that was flagged up really for Monday's trade was this June 2018 high, which we were just approaching around the 70-60 level. So if I didn't have a position within the market at that particular time, I would want to see that level broken to really trigger fresh acceleration to the upside. So that would necessarily, if I was still holding a long position, which hopefully I was, having seen the market moving higher, I'd be watching defense at this level. I wouldn't necessarily see any reason to close long positions because we're still seeing the increasing trending and volatility developing within the market. But if we broke above this high, if I was flat, it would perhaps draw me into going long of the market, or if it was broken and I was holding a long, it would give me extra confidence in holding that position. Euro US dollar, well, the critical resistance level was 120.06, which was the point that we've been highlighting for some time. Both Mo and myself have been talking about this level as being an important trigger point. So again, while momentum, trending, and volatility were suggesting that we can see higher levels, the risk would be that we would have to break above 120.06 to really trigger fresh acceleration to the upside to develop what are still more positive positions. Dollar Swiss was a market that hasn't been trending. We're not really seeing aggressive momentum or volatility signals. So again, this is really a matter of just watching and seeing where the trigger points are. Well, the trend at 89.77, which is still some way below the trading activity around Monday's opening levels, is the important focus. We would need to really break below that point to see a more aggressive move and the potential of volatility becoming back into the market within a more aggressive trend. So while I'm not necessarily trading dollar Swiss, I know where the important levels are to monitor, and if that starts to give way, it will flag up as being an important signal. And then finally, with the Aussie US, the old highs at 74.12 were important. That again was a resistance level that we would need to see broken to really trigger a more significant upside move. So basically, what we're trying to do is to arm ourselves before we actually start trading, either on a daily or weekly perspective, and really look at the more aggressive positions from a technical viewpoint, the trigger points which will develop those more aggressive trending conditions more clearly, and to trigger actual trade recommendations on the back of those moves. So we're actually armed with that information while trading is going on, and we know the important points to monitor, and if they start to give way, then that could start to develop in a more positive theme. Okay, now the one thing you will always hear all of us within these webinars say is that it's never wrong to take a profit. And you know, I think, you know, obviously that is true, but as long as there is no reason to take the profit from a technical viewpoint, I will stay with the position. So again, the question I always ask myself whenever I'm thinking of either closing a position or from taking a profit, or actually because it's not trading that well, I will always ask myself the question, has anything changed within the technical picture to justify why I actually entered the trade in the first place, or to mean that I need to change my view? And just by actually pausing to ask myself that question, it often allows me to actually take a closer look at the technical backdrop and just take a step back and reconsider the overall risks and highlight whether or not I really need to close that position But if you're long of the market and you're still seeing increasing volatility and an aggressive trend, then chances are weakness will only be a short-term setback. So again, you need to be aware of these structures and these signals and the actual trigger points before you go into trading. Okay, so that's how I look at the week ahead and approach trading on a day-to-day basis. I'm now going to hand over to Roger, who's going to cover our next trading strategy, which is trading your position around your view. Thanks very much, Roger.
Okay, thanks, Richard and Mo. And just listening to Richard there, I had some sound issues, so hopefully that was only me, but conscious of you being able to hear me clearly. So if anyone has any issues, please ping it to Chris, and we'll try and sort something out. Again, just listening to Rich there, I think it's very, very key that he clearly has discipline and a lot of patience, and that's a very, very important trait for all traders. He has his strategy, he has his process, just in identifying markets that he should or should not be involved in. And as we said in a few of the webinars, one of the key things is to let your process and your discipline control your emotions. And I think that was a great example there of having that strategy, that process, that formula. And he quite rightly said, everyone has their own formula and process, but it really, really goes a long way in keeping a lid on things from the emotional side and helping you set off on a good footing for your trading. So tonight I'm going to continue with the theme of building on the blocks that we've been through over the last few weeks, seeing how that comes into play around some trading situations that we're going to show you, and hopefully you'll start visualizing how we put some of these tools into play and some of the conversations effectively we'll have with ourselves whilst we've got some risk in the marketplace. So we're going to look at the benefits of playing the long game. Now, I don't have the statistics, but I would suggest a high percentage of retail traders do play intraday trades, and as we've always said, that's absolutely fine as long as you don't overtrade and just trade for the sake of it, and you have got some strategy to what you do. But hopefully we can show that by holding some of this risk and playing the longer game, you can certainly get some value out of it. So what does this bring for us? Well, using some of the tools we have shown you, and we'll go through them very, very quickly as a recap in the next few slides, it will give you optimal leverage throughout the life cycle of that idea. And that in itself will help your bottom line. It will help protect your bottom line as well as increase your bottom line, maximize those profits, and it gives you good risk reward as well, because you're constantly assessing that risk as the market plays out, as new events come into the market, and as price action changes on a minute-to-minute basis. It will help you be flexible around some of these scheduled events that we talk about, and in general, psychologically, it will be positive for you because there's a lot of thought process goes into it. You're not constantly under the pump in terms of having maximum risk throughout that life cycle. And one of the key things for us is that we always feel good about our decisions, and even if some of those decisions aren't right, we can understand the reasons why we made a slightly wrong decision and look to eradicate those in the future. Now, what it also does, as we do adjust our capital throughout the life cycle of these trades, is it gives us and frees up some capital to maybe look at other markets if we feel there's an opportunity for some intraday bursts of trading. And one of the key things, as we've said, the best traders are those that really maximize their good ideas. And, not all successes come in a half an hour period, a 2 hour period. Some of these trends take, weeks sometimes to materialize, and actually sitting on the same piece of risk, albeit you're changing your risk within a few weeks, picking up a 5 to 10% move can sometimes be a lot more beneficial in riding that trend than trying to pick up bits and pieces from intraday trading. So, very, very briefly as a recap, and part of the rationale behind playing this long game is that you're not always going to have maximum amounts of risk in the marketplace at any given time. So just that reiteration here, when you have your maximum amount of risk that you yourself want or allowed by systems, companies, etc., bank accounts, should only be when you have high conviction, high strength of opinion on your trade idea. And that's sometimes the way the market is set up. If at any time you're looking to just put a foot in the door because you've got a little snippet of an idea that you think you can develop, or market liquidity is very, very poor, your conviction is going to be lower and your risk has to be structured accordingly. So let's always remember this risk barometer that we put in front of you when we start trading. One of the key things is not to be one-dimensional and always throw the same amount of risk at any given trade in the marketplace. And next, we're just going to run through a quick tape, and as it plays out, it's just that reminder of some of the structures that we can take advantage of, and some that you can identify. As Richard goes through some of the technical analysis, you can identify some of these patterns. And this clearly is those sideways patterns where we constantly hit support on the downside and resistance on the upside. We keep bouncing around. There's plenty of support below those numbers as well. And as these ranges sometimes even shrink even further, it's because those that are missing out on buying or selling outside of those ranges get frustrated, bring their orders in so that hopefully they get executed within that range. Well, at some point, we know markets don't always go in a straight line, and these patterns won't persist indefinitely. So there will be a breakout. That breakout, because all those orders have been executed on the outer limits of that range, we create a vacuum. And as we've spoken, sometimes when you can identify these breaks, there can be sharp moves out of this range because all those bids and offers have actually been executed and there's no supply or demand outside of that range, and we get a sharp move. So as we move into our trade example, we are actually going to come into one of those situations, and it's that situation that is giving us a trade idea. So we actually go back to euro dollar here at the back end of May, and we start seeing this this trading range, and we actually feel at some point we could well break to the high side. Now that could be euro strength, it could be US dollar weakness, and there may be some news bubbling under whilst all this is going on that makes you feel that we're going to break out on the top side. And if we look further back at previous highs, we potentially feel it has the momentum to get up to 114.96 or there or thereabouts. And we want to participate in the move. We understand the supply vacuum, and we feel at the point that this breaks, we could have good opportunity to get on a trade. Now, as we've always said, short-term traders that just want to play this vacuum, it's going to be a smash and grab trade. As we break through that line, we get on board, we get that nice long trade on board, we see the jump, we get a nice tight stop. We can have 100% conviction because we know we've got a tight stop. So the conviction here is not so much against our idea, although we do feel it could break and we maybe feel there are some some good reasons for the euro to go up or the US dollar to weaken, depending on what's driving this trade. But it's the structure of the trade that allows us to commit 100% of our risk to the trade, because we know if it fails and it's a false break, we want to be straight out of that trade. So we have a tight stop loss, and that can dictate the fact that we can put 100% commitment into the trade. So we get that jump. Now, if, as we said, you're a short-term trader, you see those first two candles that break through the vacuum, get nice move up. The algos will be playing a little bit in that break. You're jumping on as soon as you can. And if you're a short-term trader, you'll probably be looking to take profit up there around that 110.90, maybe as you feel momentum changes a little bit. But again, that's an intraday move. You've set out as a short-term trade and keep it that way. If you've been looking at this a little bit more medium term, and as we discussed, we feel we could have the momentum. We like the news that's coming behind it that's potentially driving this, and we targeted 114.96 as a previous high. Then the one thing we have to do is resist taking profit, because in our head, we're looking at a kind of medium to longer term trade. And one of the key reasons you've got to resist is because if you do that, this market will then continue to move. Now, it's not going to move in a straight line, but what you'll find psychologically is that you may never ever rebuy on that move up, because it's harder to get into a move that's already on the way up. You haven't jumped in at that break level. You've now got a market that's pretty fluid, that has up and down days and sections in the marketplace. And one of the worst things that can happen is that you start chasing that market. You start trying to buy, and generally what happens is you buy as it starts moving up. But the problem is, because you're jumping in, you haven't got that vacuum behind you. It can also fall away, as we see. There's plenty of bouts of profit taking on that move. And sometimes you'll end up giving away the profit you made from that initial jump by buying at the highs, panicking, selling on some of the dips, because you lose a little bit of faith and you've lost the whole strategy that you started off putting into place for a medium-term trade. So that's the first key thing. If you're going into this for the long run, resist taking that profit at the outset. That's for the short-term traders. So as we move on, and we've avoided selling at the top of that, what we've got to start doing is now start putting into place all the things that we've been learning from Richard, myself, and from Mo in terms of what's going to keep pushing markets. What are the positives that are going to keep pushing this market up in our favor? And from a technical perspective, we have a nice little cross. The momentum turns up as the 3s and the 8s cross, as Richard's spoken about. They're the kind of nice signals that we need to keep looking at to make sure in our mind the momentum is there and we still want to play this game. We're still playing that long game, and that gives us the added impetus to believe in our 100% conviction, and we keep our risk. And bearing in mind at all times here, we still have our stop loss just below that break line. So even if we have some crazy piece of news that takes this back down again, we're only going to lose a small amount of our capital. You could say you had a good run for your money. And lots of people, if that happens, will say, well, I had this much profit, but you didn't have that much profit because you were looking for the long game and you were making your decisions with the information you had in front of you. So we're carrying on. We're trying to trade through some more price action. And what happens as time goes by on price action, all this is new information that you just keep consuming, and it keeps adding to your decision making. And again, you feel more in control. You're a lot calmer about this whole move. And even if it goes wrong, you'll still feel in control because your parameters, your loss parameters, are still sitting there, and you know it's nicely structured. Now, the next thing about playing the long game is that at some point you'll get a break in the market, or you'll get a scheduled event or anything like that. And it's at that point that we have to do our risk assessment. Now, in this instance, we're coming to the end of a week. And what are our assessments? Exactly to Richard's words, from a technical perspective, if nothing has changed to make us get out of our position, then why get out of that position? If you're looking at lots of other elements that go into it, you get to this situation where you either stick with your position or you reduce your risk. And that is a decision that you will make yourself. Any decision you make is right because at the time that's the decision you made with the information that was in front of you. So in this, as a seasoned professional as such, I'd be coming into this Friday afternoon move thinking, okay, I'm seeing a bit of, in my opinion, a classic bout of end of week profit taking. We actually see the 3 and the 8 cross lower. That may spook some people. But then we'd start looking at, okay, if we were to be protecting our position, where's the level that we would be concerned about? Well, clearly it's down at those lows where we saw the momentum turn upwards, and somewhere around that low of the left-hand red, that's it, where the cursor is, would probably be where you may want to raise your stop loss to protect yourself over this weekend, if you were to stick with your full amount. But if you were to reduce your risk or take full profit, absolutely no qualms with that at all. But it's what happens next that's important if you make those decisions. So if we move on to the next week and we crunch all of that up to the left-hand side, we clearly make the decision over the weekend. What's changed? Will this euro positive theme or dollar weakness continue? And we do our risk review in terms of the amount of capital we've got. We're sitting in a nice position. Personally, I would still keep my stop loss down below that break line, because the one thing I want to do for a longer term move at the outset of that move, and bearing in mind we're still only talking about a couple of days, is to give it some legs. You know, sometimes you may get some nasty little moves back down again just to shake a few longs out. And I want to stay in this game for longer term. So at the start of this move, I would recommend you keep your stops down there just to let the trend to start establishing itself. You don't want to get knocked out through some crazy move because you raised your stop a bit too quickly at the outset of this move. So then we play out the tape. And wow, look at that. It continues to move. And it's at this point we can start using all those tools we have in our bag. Each time we see the 3 and the 8 cross higher, we've got nice bits of momentum. And now as we start to see this trend establish, we can start protecting those profits by bringing these trailing stops in, as we spoke about. And so each time we move higher, the 3s and the 8s cross, or whatever signals you use, you're establishing the trend even further in your favor, and you can keep bringing those manual stop losses up, those trailing stop losses, to keep protecting. So even if this turns against you now, you're going to come out with a nice profit, and you can still classify that as a nice medium-term trade. One of the key things, as I said, once you've done your analysis, your risk review, if at any point you have decided to either take profit or on part of your position or all of the position, the crucial thing about trading medium and long term is you stick with that thought, that idea, because this has already made you some money. The reason you took profit was because it was a review at the end of the week. You maybe saw a couple of signals that started going against you, and you possibly got a bit nervous and wanted to bank some profit. The key to success in maximizing your profit on these longer term trades is that when you get back into the marketplace on the Sunday night or the Monday morning, and if you see further signals, nothing changed to worry you over that weekend, the price action starts going in your favor, The 3s and the 8s cross again, you got another positive signal. That's where you must rebuy either all of your risk or some of that risk to either get back on that train or get yourself back up to full commitment, because all the signals are still there. Lots of people miss out here. They sell out, they drop the ball, in my opinion, they take their eye off the market, and all the signals are there for them to have got back on that trend, and they haven't done it, either through a lack of discipline, laziness, or whatever. So please, 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 if you're playing this longer game and you do reduce your risk, stay with it, look at those signals. Now, if something fresh came out that did start turning it lower, obviously you can look at it and think trend over, done my job. And that's absolutely fine. But if you start seeing these positive signals, you've got to get back on that bicycle, get your risk back on board, and leverage this good idea, because it may be your best idea for the next 2-3 weeks. And so you've got to maximize your profits. So we get all the way across. And what happens now? Well, if you think back to last week, what we've done now is we've come all the way back up to the event that we were talking about last week. Now, the beauty of this is last week we were talking about using this Lagarde press conference as the possibility of getting into a long position. The beauty of this is that we've arrived at that same event already with a long position, already with nice profits, and actually we can take a slightly different stance going into this conference. We can actually stick with our long position. That means we don't have to panic when the press conference comes out, because as we anticipate positive news, when it comes out, we're already long. That's nice. We can put our stop loss exactly where we were on that, that nearest left-hand arrow from the box, because we know that's where the previous low was, and that's a nice place for us to cut ourselves out if the Lagarde press conference doesn't go the way we planned. So actually, by sticking in this long game, as new events come in, you're actually starting from a much, much more positive position. The momentum's in your favor. You're beginning to get a lot of belief in the idea. Still keep your disciplines on the downside if it goes against you, but it's that next trigger that starts helping you back up to that target of 114.96 that we set out the week before. So hopefully you can see from this example some of the values of sticking in there, some of the disciplines that you need to maintain. But again, one of the key things, those 3 words as we've put there, bit of a cliche, but every time you get these events, whether it be timely from weekends, whether it be scheduled events, data, etc., go through that process. Eat, sleep, repeat. Review what's going on, review your risk, make a decision, stick or twist, and then move on as the market continues to give you information as it goes forward. So hopefully that's helped you visualize some of the ways we do trade trends and use some of the tools we've got. And I'll hand you back to Chris.
Thanks very much, Roger, and thanks to Maurice and Richard as well. Some great content in there. I'm going to leave this up for a sec because you were talking about it, but somebody was asking, if we stay in a trade, in a strong, technically trending market, would you suggest using a trailing stop loss, to make sure you're locking in that profit? And that's why I've left this slide up, because I think that shows it essentially what you're talking about there quite nicely, doesn't it?
I think it's a great tool. I think what you're doing is playing to your strengths. You are protecting. Of course, the risk of any stop loss is that it gets triggered through some crazy move. That could be an announcement. It could be just a point where the market gets too long and it gets forced to bail out. Some of those moves can get accentuated. Liquidity disappears for a little while. So, we always run the risk. And that's why I say at the start of trying to let that trend established, don't be too keen to move your stop loss up to protect your profit, because you may get stopped out unnecessarily as that trend hasn't quite established yet. But I think once you feel you're on the move, it's quite a strong move in your favor, and you're beginning to really understand the positivity in this instance of the move, then I think these are great tools to bring up. Use your technicals to work out what's the right level. you know, in some instances, you kind of may want to stay a step behind if you want to give yourself a bit more room on those stops. But again, it's up to your own personal circumstance as well. If you know you've had a bad run and you're frightened of losing this profitability, then wherever you put your stop loss is right for you, and I think that's very, very important.
One thing I was going to say, and I'll just come to you in a sec. Now, one thing with euro especially is it takes a while for euro. You see these spikes, but because it's the biggest currency in the world, it does take time for that trend to develop and continue. It's not like you see in maybe sterling or something like that. Is that fair to say, Roger?
I think yes. So patience is a virtue. The benefits that I think it also brings is because of the depth of that liquidity, the pullbacks probably aren't quite as aggressive as well. So, you know, it's horses for courses, different style of trading, sometimes a different mentality. You know, for some people, this may appear very slow. And they want to be in a slightly racier market where you see some more instant profits, you know, and again, that's down to people's personality, and some markets work right for others, and similarly some currencies work right for others, but they've all got their own traits. But you're 100% right, you know, euro dollar probably will take longer to establish, the moves are less violent, that can be in your favor or against you.
That's why it's the beauty of your strength of conviction as well, right?
Yeah, absolutely.
Maurice, did you have something to add on that piece?
Yeah, just a little bit. I mean, I've been a long-term macro trader most of my life, and I think what I do is sort of try and time, as Roger quite rightly said, and Richard has explained, you know, trailing stops are a good idea. But, you know, be careful you don't just get married to this. If you're looking to trade on the long term, certain fundamental issues are going to play in this period. So you need to be aware of those as well. So I agree with it. A trailing stop is a good idea, but if something changes the dynamic, then don't wait for your stop loss to be triggered necessarily, because if there's something that you think has changed the scenario and it's strong enough to do so, just get out. And you know, you don't have to be married to a chart. So I do think you need to be a little flexible with your read and research structure that we've mentioned in the past, as well as this technical structure. I think the technicals give you fantastic timing and entry and exit points, but if something changes fundamentally in between that, then you know you've got a chance to either save money or make more money, whichever it may be.
All right, great. Richard, can I come to you next? We've got on the slide here, and we have talked about it in previous webinars, but for those that don't know what this is, just in case they haven't seen it before, we discussed using the 3 and 8 SMA. Could you explain what that is?
Yeah, definitely. Basically, what it is sort of confirmation of the trending structure of the market, no matter what period and time scale you're looking at. Effectively, from a trading strategy, what you're looking for is a cross by the shorter term 3-period average above the 8-period average, suggesting that the market's trading in a positive trend. And if they cross lower, then that reverses the overall risk, and the chances are that you're going into a consolidation or a bearish trend again and a more aggressive sell-off. So you can either use it as what's called a stop reverse system, in that you've always got when you're sort of active within the market, you've always got a position depending on the moving averages, or you can use it to time your entry and exit points when you're sort of looking for the potential of a trend change. But it's a structure that I find very useful in actually sort of helping me determine turning points and highlighting the ends of consolidation periods.
So on this chart that we've got in front of us, you're saying that potentially you would, when the 3, which is the red line, crosses above the black line, which is the 8 simple moving average SMA, you would say that's where you would, you would look to initiate a buy signal because the momentum's turning up. And then here, when it crosses the other way, you would consider maybe starting to sell out or be a bit more wary of that position potentially.
Yeah, no, exactly. I mean, you can build this into the structure that we were talking about earlier in terms of, establishing where the aggressive trending markets are, where the volatility is increasing, where you're starting to see momentum coming behind the move. So if you're overall, and obviously with what Roger was talking about as well, in terms of a longer term structure, so you can build this all into that approach. So effectively, if you know that you're bullish of a particular market, but you've taken profits looking for a consolidation, if you then start to see the 3 cross above the 8, then that's an indication that the momentum is coming back into the market. If you're bullish in your view, then that should trigger you re-entering your long position, looking for that bullish trend to re-accelerate again.
All right, thank you. Thanks for clearing that up. So somebody had they missed your comments on volatility because their headphone they had some sound problems with their headphones. Would you mind highlighting the factors to be considered under volatility that you used in your examples? Do you want me to go back to the slide?
Yeah, if you don't mind, that'll probably
I'll go back to those
be
slides
easier. Great, thanks very much.
Hold on one
I
second.
mean, basically, what we're looking for in terms of volatility is you're establishing where the trending condition is within the market. So you already know that the market is trading within a bullish or bearish condition. But what you need to, or what you want to see within that structure is where you're starting to see increasing volatility developing to highlight acceleration of that ongoing trend. So in these examples here, we established that Kiwi US dollar was trading in the more aggressive trending condition from the MACD. The fact that you're still seeing the mid-average rising and the bands themselves still widening, not aggressively perhaps, but still suggesting increasing volatility, that's an indication that that trend can continue and that you're looking for ongoing positive themes to continue to materialize and prices to continue to push higher. On the flip side, the one slight worry was the Aussie US dollar, where while we were still seeing positive MACD trending signals, so the market was still trading in an uptrend, we're not seeing the type of increasing volatility that you would want to see immediately to suggest that that trend is going to continue. So if we were to had to pick between Kiwi or Aussie, within this structure, it would be the Kiwi position, unless we start to see more increasing volatility developing and the band starting to widen within Bollinger's to suggest that uptrend that we've already established is now set to re-accelerate because we're seeing positive volatility coming back into the market again. So it's a way of filtering out and zeroing in on the more aggressive trending conditions.
Brilliant. Thank you very much for that. Right, and on that note, I'm going to zip forward again in the presentation and hand over to Morris so we can start the real time. Right, Morris, over to you.
Great, thanks, Chris. Okay, so where are we right now? What do we need to focus on? I've got a few things on the slides here that I think you should be focusing on. It's certainly what I'm focusing on. I think it's been quite interesting that we've spoken about this before, this move in UK assets, and we saw the FTSE put in, even the FTSE 100 put in a very good performance in November. In fact, it's best since 1989. I think some of this is foreign capital coming back into the UK, possibly on a view that maybe we might get a deal, no matter what some of the sources seem to be saying today. I think the big players are still thinking that something will be done here. Remove that uncertainty, and I think one bank this week put out a fact that they saw UK equities as 30% undervalued, so see that as a great investment for them over the next 5 years, and that sort of thing I think is beginning to attract, which is why sterling was fairly well bid. So that's what I wanted to put in bold there. Read through the others there as well, they're important. I think the Pfizer getting regulatory passing in the UK is interesting. I think the Pfizer one is the one that obviously needs the very deep freeze. The Moderna and Oxford ones, once we get regulatory approval on those, then I think that's going to allow the vaccine to be delivered in more volume. I think that's going to make a difference. I think it's market positive. And so I think that keep an eye on headlines for that going forward as well. So inflows, interestingly, into equity funds have outperformed, and they're massive at the moment. So this tells me a lot of cash on the sidelines is being put to work in equities now. It does raise the question that we're going to try and address at some point in the following slides, but it does make one ask whether an awful lot of the expectations or good expectations or forecasts are now priced. On the central bank and political news front, over on the right hand side of the screen here, obviously the Brexit farce continues, and to be honest, they really need to sit in a dark room and not be allowed out until they get this sorted, but unfortunately this is the way politics works. There is an idea that we're getting close to the last chance saloon here, that they need to get something done. Both sides need it, although there is some concern that it's insurmountable differences. Well, we'll see, but I think the fact that deadlines keep passing makes me suggest that both sides do want something. But I was a bit upset when I heard that some EU nations may want to see the compromise before it's put through, which could be more delays. This is typical of the way the EU works, and we'll probably end up with some weak fudge at the end of it that does nobody any good, but there we are. Hungary and Poland, I think this is in highlighted points because I think it's really important. They're still holding out against this EU on the budget and the rule of law issue. They are going to veto this still. They're trying to be talked out of it. They're looking at legal ways of going around Hungary and Poland, but this is supposed to be a 27 nation unity. But there we are. We'll see what goes with that. But that is a threat to the euro, and it's a threat to the EU. So I think you've got to keep an eye on where that goes. That's worth keeping an eye on the headlines. I think the others are just ongoing issues, but at the bottom, again, we had Fed Chairman Powell say they stand ready to use all the tools in at their disposal. There is some talk that they might do something at the December meeting. I think it'd be worth keeping an eye on what Powell has to say in the press conference and whether they do actually go ahead and do anything. I think markets might be a little disappointed if they don't, especially with the ECB expected to do something. So I do think that's going to be a couple of interesting central bank meetings coming up. So that's what is going on right now. I think if we move forward, we can suggest, rather look slightly backwards. I think we can look and see what a month November was for stocks. I mean, it was an incredible month. World equities on a global structure headed to a record-breaking month, blew things out of the water. It was just a very strong month. Within that, quite a lot of rotation. A lot of the unloved stocks through the lockdown have come out and burst into the headlines. Investors looking to move from the high growth tech stocks into the more basic hospitality, travel, all those that got butchered in the lockdown are suddenly back in vogue, and this has been very interesting. Energy stocks also doing very well, which has also helped the FTSE, by the way, and mining stocks. Commodities on a roll with a lower dollar. Surging smalls on the right there. Now, I think it's really important that you understand that not everything in the US is about the NASDAQ or the S&P. The Russell 2000 index is the small cap. So we have the mega cap tech stocks and we have the small cap, which is the Russell. The Russell is outperforming everything at the moment. And this is the small cap market, best month since 1979. Those unloved stocks that you see, those spikes below, are way up now. And they've had a stunning recovery. Now, some people say, well, that move's done. Well, if you look at where they're coming from and where they were not long ago, there's still some potential upside on those. So again, within the stock markets, there's been some rotation, but overall stock market's doing very well still. And the dollar on the back of that has been weakening as well. So it was a big month. Going into December, I think we're going to have more influence from data, and we spoke earlier about the impact of soft data over hard data. Now, the hard data, the retail sales, consumer confidence, unemployment, and things like this have been starting to sort of drift down, which is not very encouraging. And all of a sudden, we're just starting to see a rollover on the soft data. So people often ask, is the soft data going to catch down to the hard data, or is the hard data going to catch up to the soft data? It looks at the moment like the soft data is going to start drifting down to the hard data on this chart. This is a bit of fun, this chart. It's not a massive science, but this does extrapolate the survey data from the hard economic data we get. And I think it's quite interesting because the forward-looking data is starting to become a little more negative. So keep an eye on that. And I think on the right-hand side here, you can see ISM manufacturing. The new orders part of this was rather disappointing. In fact, very disappointing. And I think that is a future canary in the coal mine for me. And I think the business employment side of ISM as well, turning down. We saw some weak components in the PMI employment component as well. Could be a precursor to a slightly weaker non-farm payrolls on Friday. But we also had a weak ADP, which is the private sector employment today. That wasn't great. I'm going to be keeping an eye on initial jobless claims tomorrow. I think that's going to be it's another high intensity data, well worth a look. The last 2 months, 2 weeks have been starting to trend higher, which is a bit of a concern. So some may question, looking at this, whether the US economy is topping out. And I think there are some early signals that we need to bear in mind and structure into how we look forward at markets. So I'm getting a few warning bells, if you like, that are making me sort of think, well, where we're going to go with this. So I think for stock markets, central bankers remain extremely nervous. There is a massive disconnect between investor confidence and consumer confidence. Now, I also think you can throw in there central bank confidence as well. Central banks are still very dovish. They're still very concerned about the gap between now and when we get a vaccine that is in everybody and we can actually turn the corner on this thing. And I think that they're not sure when it's going to be. Equity markets, investors are looking through that, just looking at the recovery, ignoring any risk in the short term. That could be dangerous because bond markets are not actually suggesting there's a great deal of confidence out there either. So the UK has acted swiftly with policy. I think the UK has done a lot. They've acted swiftly with fiscal. They've acted swiftly with the vaccine coming up, possibly distributed early next week. To be quite honest, I don't think they could have done a lot more. Yeah, there's a lot of faffing around with the Brexit issue, but I do think that the UK has been one of the better areas for sort of trying to bridge the gap, if you like, between now and when we do get these vaccines taking effect. And I think that could keep sterling bid, actually. Yes, there was some negativity today on the Brexit issue. I still think some kind of weak compromise will be found. I think it will be a headline that takes sterling up. Whether it lasts or not, I don't know, but I think UK assets will be in demand over the next couple of years. So I think that could be a supporting factor for the UK. I think obviously the unemployment data is going to be big. I think initial claims tomorrow are important. Anything to do with employment anywhere. One question though, could a bad payrolls number cause some nervousness for stocks into the end of the year? End of the year is a volatile period of time. We get massive rebalancing for the year end. The market's been more or less one way for a while, so it does concern me. There's some pretty big consensus all-in trades, if you like, in equities, and I just wonder whether that can hold into year end, but we'll see because it's a volatile time. Currency markets, I mean, the weakness of the dollar is becoming quite a strong consensus, but I think there are pretty good reasons for that. And for me, one of them is that even if we get economic growth in the US or globally, I don't see well, in fact, the Fed has told us they're not going to move rates on the back of that. So when we usually get a US recovery, we see interest rates start to nudge higher just to keep inflation in check. They're not going to do that this time. And so that means that even with a recovery, we may not get the dollar bounce. And so there is still an argument that we get stronger growth maybe in Asia and places like that. And the money goes that way, which could be a drain on the dollar as well. Obviously, I've mentioned Poland and Hungary still issues. I've mentioned Brexit still waiting for the end game. We could be waiting a lot longer, who knows. We've had RBA governor speaking. Does feel that the recovery's on track, but don't forget he's a central banker, so he's hoping rather than knowing. But one of the things you've got to remember with the Aussie dollar is there is still this escalating China trade war, which knocked Aussie down earlier this week. And I think we're struggling to get back to this 74.12 level. I think we're testing it as I speak, actually. But, it's been sort of it had some of the momentum taken out of it, and this is not going away. They're a huge buyer of Australian wine, and they've just slapped a 200% tax on it, so it's unsellable in China now. So trade with China is actually going pretty badly with Australia, and they are being asked by China almost to take sides, which is very worrying. And I don't know what Australia is going to do with that in the longer term. So I think we saw a really big bounce after a very heavy sell-off in gold, and I think the dollar fall is helping that. I think what's going on in some structures of US yield bond markets is helping, but this dollar fall is driving commodities higher. Copper at 7-year highs. Now prices in very many basic commodities are rising. Now, if we do get some pent-up demand from consumers who are then going to go out and buy, and prices are already moving higher, if we get this, say, in the spring, there's a very real danger that we could get a spike in inflation that the central banks have not been ready for, and in fact have said they're going to ignore. So that could be rather damaging. It'd be interesting to see. So I think, we've spoken about having bonds on your screen. I think it's probably worth having these back on your radar now, just watching what yields do, particularly in the US over the coming weeks. So that's where we are looking forwards on ideas, but I think obviously, keep the event calendars in front of you. We've got a big finish to the week. I've highlighted here in red what you should be looking at. All data is pretty important, services in China, but the ones for me, initial jobless claims tomorrow, 1:30 London time GMT, 1500, we get the ISM non-manufacturing. This is the services part of the US economy. If that's weak, then I think we need to be a little bit careful as well. But a lot of people think services are holding up in the US because no one is taking a blind bit of notice of COVID in America at the moment, but they may have to. Payrolls on Friday obviously is the big one. Within that, remember, we have average hourly earnings, which are a very important component of this as well, and the underlying unemployment rate as well. Also, at the same time, unfortunately for Canada, they're come out at exactly the same time. If you trade Canada, sometimes you can get a double whammy on there with that, the dollar going one way and the Canada going the other way. So just be careful with that. There's quite a bit of volatility around on Canada sometimes through that. So busy Friday, busy Thursday potentially with equity markets up here. Very quiet day today on equity markets, but I think we're on hold, ready for a busy end to the week. And on that, I'm going to pass you back to Richard, who's going to carry on talking about some of the live markets, a favorite part of the section for me. So I'm going to pass you back. Cheers, Rich.
Great. Thanks very much, Mike. Yeah, I think certainly the general themes that we've held still persist, and that has been technicals have supported further attempts to push higher in equities, and the general themes for the US dollar have been for weakness for some time, and that continues to materialize. And I think the evidence certainly at this stage is that there's no real indication that that is coming to an end, and that the overall risk are for these trends to extend. So starting with the current backdrop for equity markets, this is the weekly chart of the S&P index. And just basically to sort of highlight, I mean, obviously the main question is, well, if equity markets start breaking to new highs, and we're in uncharted territory, literally, where do we look for potential pause levels or potential objectives for that particular move? So this is actually where Fibonacci extensions come into play. And I just thought on this weekly chart, I would highlight where the next sort of resistance points develop if we do start to see breaks of this old all-time high, which still seems to be on the cards. And basically to get the extension points, all I've taken is the last significant correction. So it's this sell-off here that we see the 4 consistent weekly bearish candles, and then project up using the Fibonacci retracements that we've spoken about previously. But instead of using them as retracements, we're actually projecting them higher into new high ground, so using the same extension point. So the 38% level becomes the 138% extension, which currently stands at 37.28, while the 162% stands at 38.16. And these would be the potential next resistance points to monitor if we do start to see equity markets and the S&P breaking to new highs. Now, obviously, that leaves the question, are we going to see the successful break higher? And I think, technically the overall risk is that that is still the bias. We're still looking at more positive themes developing. This is the daily chart of the S&P now. And while we have seen an easing slightly in the volatility, so that the bands have contracted as the market has sort of paused within its recent upside move, I think the general structure is still a more positive trending condition. And the risk is if we do start to see these old highs give way, that could start to see a catalyst for increasing volatility within the positive trend. So, I think, yes, we're looking at the old highs as an important resistance point, and going back to what I was talking about earlier, we're prepared with that point in mind that if we do start to see a break, then the chances are that we would see increasing volatility, a resumption of the positive trend, and the important levels would then become those extension points. In the UK, I sort of highlighted potential for divergences within momentum and trending indicators. So in other words, the most recent highs hadn't been confirmed by new upside extremes in both the MACD and stochastic. And that was a bit of a worry, but we haven't developed that. We haven't really established ourselves below the last correction low. And we can actually start to see a slightly improving backdrop within the Bollinger Bands, in that we're now starting to see them widen. Yes, the important resistance point is this old high, and that will be the level that we need to break above to start to see the trigger for higher levels. And that's, I think we need to see that give way and the market start to see this acceleration develop. But the overall structure is still one that looks as though we can start to see that materialize over coming sessions. So we know the trigger point. We're already starting to see improving volatility within the bullish trend. So that could be more, you can paint a more constructive picture here. In terms of the FX markets, and as we've said, the weakness in the US dollar has been a clear bias from a technical perspective for some time now. The question mark with the euro and euro dollar in particular has that we've been looking at these sort of horizontal lines I've drawn on the chart as resistance points. So first we had 119.06, 119.19, which was a level that I was sort of needed to see broken to resume potential towards upside. And then we had the old high at 120.06, which we've now broken above and established ourselves above that point. So again, we're starting to see re-acceleration of the upside. We've broken the important levels that we had in our mind as important resistance points. And we know that if they start to give way, it would start to trigger a more sustained move higher. As you look from the weekly chart, without indicators, just purely price, you can see that the general trend is towards higher levels. This looks very much like a consolidation as a reaction to overextended conditions after this strong upside move. And the potential is for a similar sort of move to the upside, which would still suggest we could potentially test, even break the previous highs that were posted in 2018. So again, the overall structure, this is a combination of euro strength and US dollar weakness. So we started to see euro appreciation developing this week, and that still seems to be an ongoing theme, looking for further strength to develop. Kiwi dollar has always been my favorite within this latest move. It's performed very well technically. We've seen consistent outperformance against not only the US dollar, but all other G10 currencies as well. So, the general trending condition is still very much in place. This is the daily chart. The overall structure is still towards higher levels, and the risk is for a continuation of this upside move. So I think, the general risks that we have in place within this type of activity is for further extension of positive themes and to look for the important resistance levels where we're breaking above this old high point that we had previously, and that leaves little until the sort of March 2018 highs. And again, This is the type of activity we need to see from Bollinger Bands once we start to break important resistance levels. Increasing volatility, widening bands within a bullish trend, and prices tagging the upper band. That suggests ongoing positive risks and chances of a more extended move higher. So the overall backdrop technically is still one that suggests dollar weakness and Kiwi strength. Now, we were looking at earlier at the dollar Swiss chart and sort of saying, well, this is a sideways trading range. We need to see a breakout. This is the daily chart. Well, you can now see that today we've seen a successful break lower, having seen the acceleration to the downside yesterday. And the overall risk is that this is completing a bearish continuation pattern. So the overall risk is for lower dollar, and we can continue these bearish themes. So the overall backdrop for the US dollar is still negative. Now, cable is slightly different. This week, yesterday we started to see strength in sterling. That's been reversed by today's move. The important support point, I think, is this last correction low trade. If we start to see this give way, then it would be important. The reason being that the momentum and trending indicators have both failed to form and to see new highs. So we have the double divergence, if you like, from momentum and trending. If we now start to break under this last correction low, that would be a negative and suggest a deeper retracement and sell-off is possible. So with sterling potentially seeing weakness develop and euro continuing to see more positive things, we've obviously this week started to see upside acceleration developing within euro sterling. But interestingly, today's move, you can see where we've been held. It's on the 50% retracement of this entire sell-off around the 90.76 level. And that is a definite point that we would need to break above. So that wouldn't be the next trigger for a move towards the higher retracement around the 91.26 level. But certainly we're going into trading knowing that that 90.76 level is an important focus and a point that we need to see broken to trigger a much more sustained move to the upside and maintain the euro outperformance over sterling. Then finally, I just want to have a look at gold because we've obviously seen an aggressive sell-off developing recently. But again, as one of the founder members of the Fibonacci Appreciation Society, you can see again where the market held, where we started to see a reaction developing. The 50% retracement level of this entire upside move held. We saw rejections from lows, so lengthening lower shadow, as we started to see within candlesticks, which we know is an indication of rejection and confirmation of support, and more positive themes beginning to develop to see a recovery developing. And this is another reason why we need to be aware of the important support and resistance levels and trigger points within the market, not only to enter trades, but also to look for where important support levels could develop and would be a reason to close short positions in this case against such an important support point, especially when we started to see the rejection developing on Monday, to see a more sustained recovery. It may fail at this first retracement level around the 1841 level, but again, that is a significant bounce, and this would be the next area to monitor. If that starts to give way to the upside, risks would be for a more extended recovery. But against this resistance, we'd be looking for evidence of failure and a resumption of downside, because this is still a more negative setup, and we could look to retest this old retracement point. But we know the levels, we go into trading knowing the levels, and we know where the aggressive trending and volatility signals are in place. And if those levels start to give way or indeed hold, then that's an important piece of information that we need to structure within our trading approach and adjust our risk accordingly within our trading strategy. So that's the technical backdrop. I think the general theme is still for more dollar weakness. Equity strength is still a potential, certainly if we start to break above the old highs in the S&P, but the general trends are still very much evident with no real signs of them ending just yet. So I'll hand back to Chris, who's now going to look at any of your questions. Thanks very much, Chris.
All right, thanks very much, Maurice, again, and thank you, Richard, as well. So question for you, Maurice. One of the attendees was asking, do you think a no-deal Brexit will severely damage the UK markets and the pound and send them into free fall? That's question one.
There's a danger of it. I think the only issue I would say is that I think sterling would definitely take a hit. But a weak sterling, sometimes actually you could see the FTSE 100 actually do okay with a much weaker sterling, because it's not a domestically grouped set of businesses within that. Underneath that, I think the recovery we've seen in like the 250, 350 in FTSE would take a knock. I think that uncertainty would see capital leave again, and I think it would be bad news for the UK in the short term, and therefore, yeah, I think sterling would take it down. I think the underlying businesses would struggle, but don't forget, a weaker sterling does help the energy companies, and don't forget, most of them are energy and mining, so not a lot of what we do in the UK is reflected in the FTSE 100.
Okay, and if we was to see a fudged, as you talked about, Brexit deal, do you think that the market goes higher on that, and if so, for how long potentially?
I think that's a very good question. Now, a weak fudge, I think the headline that we've got to deal will see sterling and assets do relatively well. The FTSE may struggle if we get a big bounce in sterling, but I think the sterling bounce could be limited, because I think quite a lot of it's priced, but I also think that a weak deal still may have us attached to the EU. It may be a bit of an anchor on us. It depends what the deal is. We need to look at the detail rather than just trade the headline. But I do think over time, with the undervaluation of UK assets as they clearly are, I do think real money will start coming back into UK shores and start propping up sterling again. So I think you could have a very whippy time for 3 weeks maybe in sterling, up, down, and down again, and out, up, and then all of a sudden I think you could see some steady capital inflow looking for those undervalued UK assets with some of the uncertainty removed. The only caveat to all of that is that we get this kind of deal in principle idea that we've got a deal, but we've got some more talking to do. That is not very good for the UK. It's more delays. It's a classic way of the EU wanting to do things, and it means we haven't properly broken away either. So I think that's not great for the UK. I think we need to get something done, a deal done, and walk away from the whole thing and say, right, we can now move on. All of us can move on. If we get that, then I think it's a real positive. If we get much less than that, I think the markets will have some doubts still.
Okay, great. Richard, one for you. Somebody was asking about, how to avoid chart noise in terms of charts. You've got so many different things pinging at you that sometimes one counteracts the other. You obviously go through your process, and they were also asking about, sometimes on your charts you'll have MACD or stochastic and Bollinger Bands. Could you just run through your, just how you use them all together, just briefly? I know you've put it in the presentation earlier, but just to run through those again, that you're looking at those on a daily basis, and then any advice, on how to avoid chart noise.
Yeah, I mean, certainly, I think the approach that I have, as I say, concentrates on Bollinger Bands, momentum, via stochastics, and the MACD. And basically, I'm looking for one to confirm the other. Now, the longer term signal will always come from the MACD because it's a moving average based indicator. So you're effectively looking for that, and because it's a trending indicator, you're looking for that to give you the longer term, if you like, trending conditions of the market. And effectively, what I'm looking then to use is momentum via the slow stochastic to highlight the types of signals to time trade. So in other words, when you've got an aggressive trend and you see momentum turn higher, then that's certainly a signal that would suggest that that aggressive trend is going to extend further and is going to continue further than people are anticipating. If that's seen alongside or closely followed by increasing volatility and bands starting to widen, then that's the perfect setup, in that you've got the longer term trending condition in place, momentum turning up in that situation, then confirmed in due course by volatility increasing. to give you extra confidence within that trending condition and that acceleration trade. And that effectively is the ideal scenario that I'm looking for for the setups. If one doesn't confirm the other, then it reduces my sort of commitment to that idea. Conviction would be reduced, so I would either reflect that in not doing anything or reducing the size of the trade, and then look to add once we start to see other areas fall into line and confirm the general trending backdrop. As for trying to filter out some of the noise, it can be very difficult, and you will get signals that will whip you backwards and forwards in terms of bullish and bearish signals coming quite quickly, one after the other. That you would tend to find that setup occurs when you've got Bollinger Bands moving sideways. So you've got a flat average and the bands themselves are parallel or converging to highlight a more balanced, choppy trading condition, which effectively is saying, we'll step back a little bit and see what happens. So, and I guess the classic example, something that we've looked at would be either Aussie US dollar or dollar Swiss, where more sort of choppy sideways trading areas were being seen, but we're now starting to see breaks of supports and volatility starting to increase. So that would give me extra confidence within that trade. I wouldn't have had a trade necessarily at the beginning of the week, but now it would look as though we're starting to see that type of activity developing again. So it's more a matter of just sort of looking for the general structures to try and filter out some of the noise within the market and wait for the more aggressive trends. Because if you can establish the trend early and you stick with that trend, then that's obviously where the greatest potential is. And as long as everything continues to point to that trend extending, then you just stay with the position and continue to monitor stops and the volatility of activity. But as long as you have that setup, then the risk is that trend will continue, and that's where the greatest potential is to take advantage from a trading perspective.
All right, great. I mean, I guess Roger would say as well, potentially, and obviously he's on, but you would say, Roger, sometimes you're not always going to have every single perfect piece of information pointing the same way. So, sometimes you have to go with your feel and accept that trade. And yes, there might be a few negatives, but you're not always going to have everything pointing in the same direction.
Yeah, that's where your gut feel comes into it. That's important, certainly getting in trades as well as sticking with trades. It's that balance, isn't it, between, consciously knowing you're in a trade and, you do a bit of a tick box exercise. This is in my favor, this is in my favor, this is in my favor. Maybe this one's a little bit dodgy. It still means I'm comfortable being in the trade, but I want to hear about if anything changes in this area. That is a reality of marketplaces, and that's a good understanding of a market simply in the fact that holding a position in a market is risk, and it can go up and it can go down. I'd much rather approach it from that attitude than this over emotional getting married to a trade. So sticking in these trades, you're always going to have some, or you should, in my opinion, always have some air of caution, because the art of our process is questioning yourself all the time. And if that's a much better process and more robust, and will certainly protect you more than those that emotionally just get carried away with it, get emotionally attached to it, and just refuse to stop themselves out where they should be. So I'd rather be on that side than the married situation.
Can I just say something, Chris? Just add something.
Yeah, please do. Yeah.
With sort of quick ending, but I think it comes down to confidence in your opinion of the market, and the way I would suggest using technicals and the way I try to use them is to give you that extra confidence in your view. And as long as the stars are aligned, then that confidence should be high within that trade until something changes within the overall structure. But I think anybody should be using technicals to back up and strengthen their own particular views, and to effectively use it to add or take away confidence, and that should be reflected within adding or taking away risk within your position. And it's almost it's like the barometer that we've spoken about, that Roger's spoken about before. It's that confidence and that high conviction that you gain from using the indicators and knowing how to structure the overall backdrop that we're looking at.
All right, great. I mean, we just have one last question very quickly, Maurice. I mean, it's a tough one, I know, but if there was a risk out there, and if it was a risk that was crystallized, what's the biggest worry for you that's on the horizon that maybe might see equity markets fall quite dramatically?
Horizon depends on your horizons, but mine, I'm looking at bond markets. I'm looking at inflation. The market is in a deflationary spiral. Everybody's talking about deflation. No one thinks interest rates can rise for 3 years or 2 years, but the amount of fiscal spending that's coming, and propped up with the monetary support, there is a very real danger here that a vaccine that is actually deemed to work well and does actually immune us to this plague, then I think we could get some pent-up spending, and prices are already rising. Now, it's not picked up in CPI because, but everything I use, food, petrol, everything has gone up recently. So, I only buy one freezer every few years or one car every few years, but the everyday stuff is rising in price. That does worry me a little bit. It's going to take a little time to come through, but there's just some warning signals out there, and the bond market's beginning to notice. So I just have a feeling that if anybody gets a whiff that there is inflation coming, and central banks might have to do something about it, then stocks are in trouble. But until then, they seem to want to ignore everything and just look at everything that's positive.
All right, brilliant. And on that note, we'll leave it. Thank you very much to everybody for attending this evening, and some great questions. Thanks again to the mentors. We'll see you next week. Have a great trading week ahead. All the best.